Hi guys, this is Toby Mathis from Anderson Business Advisors, and today we're going to talk about nothing but selling your house. And when I say your house, I mean something that you've lived in the last 2 years as a personal residence, or excuse me, the last 5 years, but you had 2 of the 5 years as your personal residence. So what we're really looking at is something that you have lived in as your primary personal residence, not a vacation house or anything like that, something that you actually lived in as your primary residence. And we'll go over the tests because there are some exceptions, but we're just going to start from the basis that you need to have lived in it 24 of the previous 60 months before you sold it. And then we'll go over what all the exceptions are, etc. off of that. So first thing to know, all assets that you own, whether it's a car, your house, anything like that, is considered a capital asset. And when you sell it, if it's gone up in value, or if you wrote it off completely and it's gone up in value, you're going to have some amount of taxable gain. So if you bought your house, and we'll talk about how to do the calculations, but if you bought a house and it's gone up in value, you're going to have some sort of capital gain. If you lose value, if you used it for personal use, you don't get to write it off. That's why if you buy a house and it tanks, and you sell it, you don't get any benefit. If you buy a rental property and it tanks, you get to take the benefit. If you buy a house, convert it to a rental property, then it tanks, you get to write it off. If you buy a house, live in it as your private residence, and it tanks, and then you convert it to a rental, then you sell it, not the same thing. There's all little variations, but I hope you guys get the gist. Capital gains is what we're talking about when you sell an asset. For homes, there's an exclusion to the capital gains. It's found in Internal Revenue Code 121. That's why they call it a 121 exclusion. And this is the part of the code that says if you've lived and you meet a certain test, if you own the home and you lived in it as your primary personal residence for 2 of the preceding 5 years, you have a capital gains exclusion of, as an individual, up to $250,000. As a married couple filing jointly, up to $500,000. So in English, I buy a house for $100,000 with my spouse and own it for 10 years, lived in it always as my personal residence, and I sell it for $600,000, I'm going to pay 0 capital gains. Because when you look at the look-back period, this 5-year period, did you live in it 2 of the last 2 years of the last 5? Yes. Was it your primary residence during that period? Yes. Great. Then we have this. Do we have any periods of non-qualified use? In other words, did you rent it out in any period of time? No. Then we don't have to worry about it. Great. 100% exclusion. That $500,000 of gain is excluded. You don't have to report the gain. You pay 0 capital gains tax. That's why it's so powerful. All right. So first off, I'm going to contrast this 121 exclusion, which is for the house that you lived in. Keep in mind, primary residence 2 of the last 5 years. It's not the last 2 years, it's 2 of the last 5. So in theory, I could have lived in it for a number of years and then rented it for 5 years, and I would still get my 121 exclusion. It's capital gains exclusion. If I rented it for 3 years, there's a good chance that I would have depreciation. That is not part of the equation. I do not get to avoid depreciation. For you guys that had home offices, that where you did the home office deduction as a sole proprietor, that's also considered depreciation. You also get to recapture that. So there's some little points in here that that can make it complicated, which is why it's so important that you listen to these types of videos, because there's lots of little pieces to it. And you're going to see the exceptions and the variations can get maddening at times. But what we're looking at is, in the last 5 years that I owned it, did I meet the use test? In fact, I actually use a step-by-step. So I say step number 1 will be like, hey, what do I get, like what will automatically disqualify me? Like what things would make it to where I do not get to use 121? Number 1, if you're an expat, you don't get to. In fact, what do they say? You're subject to expatriation tax. You're done. You don't get to take the 121 exclusion. How about I 1031 exchanged a property, now I've lived in it, but I have not lived in it for at least 5 years. Or let's see, yeah, that you acquired the property in exchange during the last 5 years. you're done. You do not get to take this. If it's longer than that, you can actually still qualify. And then if you don't meet the use, use and ownership test, then you do not get to take the 121 exclusion. Now, to that last test, the use and ownership, there are some exclusions for partial use, or there's some periods of time where we can actually defer, which is when you are active military, Peace Corps, things like that, and you get deployed. And we'll go over that. But the first thing is to look at this and say, first off, do I fall into one of these exclusions? If I do not follow into one of the exclusions, then I can start looking, and I'm going to be able to work underneath the statute, the 121, and I might be able to exclude. Then we look at the limitations. It's not 100% of the gain. It's not a percentage. It's a dollar amount. And so if you're single, the dollar amount of capital gains you can exclude is $250,000. If you are married filing jointly, the exclusion is $500,000, but both spouses must meet the use and ownership test. This is where it gets funky. What if you get a divorce and you give the house under a decree to your spouse? Guess what? You no longer meet the use test if you're the one who got rid of it. The person who is selling could actually use your use and ownership as part of their time. I mean, your use, because they're the owner now. So let's say that I get divorced from my spouse, spouse takes the property, spouse sells the property. They can use the group of us, even just mine, if I'm the divorced spouse, they can use my use. But since the ownership is in that, is just in the spouse that got the property, if it's in their name underneath the decree, and they transfer that property into their name, they're the only one who can have ownership. So you, as the person who divorced, it's not your exclusion. It's their exclusion, but they can use both. They can use both to qualify. Now, if it's just them, what do we have? We have a $250,000 exclusion. If you guys are trying to do it for yourselves, then when you divorce, you better make sure you're both listed on that property, and they're going to calculate up you still have to meet the use and ownership test. You're both owners. Now you both have to meet that use test. So you're going to add you both up, which can be that could be a boon, or it could be like a horrific mistake if the lawyer doesn't catch it and you guys transfer title to somebody. There's a few others which we'll go over. But we look at it and we say, are you the owner? And what they look at is, if you owned the home for at least 24 months, 2 years out of the last 5 years leading up to the date of sale, you meet the ownership requirement. For a married couple, if you're still married, only one spouse has to meet the test. For ownership, you still both have to meet for use. And that's the next step, is we look at it and say, what is it used? It has to be your primary residence. So here's where it gets fun. If you did, then, and the 24 months can fall anywhere within that 5 years, then it has to be your primary personal residence. So some people have two personal residences. It has to be the primary, and they actually do some tests. And so they're always going to look and say, where did you actually stay? Now, there are some exceptions if you can't take care of yourself and things like that, but we're not going to get into that. That's for somebody who has to, who needs assistance and actually has to be removed from the home for reasons which we'll get into. But let's just say, for general purposes, you must own it and have used it as a personal residence. You have to own it at the time that you're selling it. You have to have used it as a personal residence in 24 of the, or 2 years of the previous 5. Then we look back and we say, are there any exceptions to that eligibility? And that's where we have some exceptions. So let's take a look. A separation or divorce during the ownership of the home, and then we take a look. That's going to be exception for the use, not the ownership. So again, if you no longer own the house and it sells, it's not your exclusion. It's the spouse that owns it. If you both still own it, you're both still on title, then we can add it up and you guys can actually both get your exclusion. Death of the spouse. Now you have a period. You have a 2-year window of where you would sell it, and they would treat it as though you would be able to take advantage of both spouses as owners. Vacant land would be carved out potentially if it was used as part of your residence. So like if you had a big yard and you sold part of the yard, then it may be part of your exclusion. You might be able to get a portion of it. And finally, there's some other exceptions, but we won't get into those right now. I just wanted to touch on each one of those. If you are spouses and you don't make up and you don't meet the 24-month test, and you're looking back at the use, what they would do is they would say, we were going to treat you each as single individuals. So the spouse that lived in it previously, that still owns it, and you're selling it. So, you know, example, I lived in a house, I get married, we sell it a year after we get married, and they would say, oh, you're not completely toast, you're not completely excluded, you would just treat you each as single people, and so my use and ownership, I might meet it. So I might get a $250,000 exclusion even though we're married filing jointly. I don't get the full 500, but at least I get the 200 or the 250. And let's say that it's jumped up in value and I meet one of the exclusions to that eligibility test, the exclusion, like we had to move for work or for health, and I'll go over what those are, then I may even my spouse, even though let's just say she did not live in it for 2 of the last 5 years, she would fall under one of the exceptions for a partial exclusion, then we would get hers as well. So there's always little nuances. Like I said, this stuff can get maddening. If anybody ever says, oh, it's just straightforward and easy, it is not, I assure you. So then we look at the limits. And so we look and say, do you meet the use and ownership test? And then let's take a look and see, are there any periods of disqualified use? And here's what I'm talking about. Disqualified use kind of goes like this. I'm a landlord. I own my rental property. And then some smart lawyer says, hey, make it your house. And if you sell it, you have this big exclusion. Okay, I have a period of disqualified use. So let's say that I had it a rental for 10 years, and then I lived in it for 2, and then I sold it. I would have a large portion of the gain disqualified, the 10 compared to the 2. That's the proportionality, and they would say, hey, you're going to get a 2/12 portion of the exclusion because you lived in it. When we add up all the days, and they actually go by days, not by months, you go by days, and you say what portion of it was the residence and what portion of it was used for business. So there's a big portion that could be disqualified. We call that disqualified use. That's going to give you a partial exclusion. The other portion is like things that will automatically exclude you is you're only allowed to take the 121 exclusion once every 2 years. So I can't have a house that I lived in for 2 years as my primary residence, buy another one, live in that 2 years, and then sell them both in the same year and expect my exclusion. I get to take one exclusion every 2 years. What I would have to do is sell one of the houses, make sure that I'm still qualifying for the other one, and then wait 2 years and sell another. There's people that do that, and they use the exclusion every 2 years. If you try to sell one within 2 years, it's just an automatic denial. That's just an automatic exclusion. The other exclusion, as we talked about, was if you 1031 exchange within 5 years. Just done. You 1031 one of your rental properties, and then you moved in it for 2 years, and then you sell it, you 1031 within 5 years, done. You don't get to use the 121 exclusion. You're just done. And then the other way is just to fail the use and ownership test, in which case there we have some exceptions, what we call partial exclusions that we could use. So it's kind of step number 1, going all the way back to the beginning, is you determine whether there's things that automatically keep you from qualifying, assuming that you're not an expat, that you didn't just 1031 exchange it, that you haven't done an exchange within the last 24 months, then we're going to take to step number 2, which is to look at the use and ownership test, and we're going to go through that. We're going to determine whether there's a period of disqualified use, and we're going to calculate all this fun stuff. Remember, this is only for capital gains. So there might be some depreciation that gets to be recaptured. And when you do the worksheet, when you actually look at what the IRS requests, when you actually do the calculations, you're going to see that that gets excluded from gain. And I'll go over how you actually do the calculation here in a second. And that portion is going to be subject to dividend recapture. So again, going back to the example of I owned it as a rental for 10 years, then I lived in it for 2, then I sold it. there's 10 years of depreciation. That's not part of the gain. That actually comes off the top, and that's subject to depreciation recapture, which would be at 25% right now. That would be subject to that taxation. I can exclude a portion of the gain. Like, I don't just lose it. I would get 2/12 under that example of the gain excluded. So there's always these kind of exceptions. The other area of exception is if I was forced to move. So let's say that I owned it and I sold it, but I didn't meet the use test. Then there are a few exceptions, and this is when we look and say, do I get a partial exclusion? And here's the partial exclusions. So this scenario is, I lived in the house, I lived in it for a year as my primary residence, and then I had to sell the house because I was forced to move for work. And if you worked, then it's going to be at least 50 miles farther than the old location. 50 miles farther from your home. So it's not just 50 miles away, it's 50 miles farther away than your old location. And so let's say that you had a house and you commuted 15 miles to work. The new house needs to be at least 65 miles away. Hope that makes sense. And then I can get a partial exclusion. So if I'd be entitled to a $250,000 exclusion if I had lived in it for 24 months, but I only lived in it for 12, then I would get a $125,000 exclusion. I would get half of the exclusion because I lived in it half of the time. That's the partial exclusion. A health-related move will work also, and that's if you had to do it to facilitate a diagnosis, to cure some health issue, or if you had to care for family members, and the family members can be a child, grandparents. They actually have a list: brother, sister, mother-in-law, aunt, uncle, nephew, niece. All these things could be included. And then they have some catch-alls. They say unforeseeable events. And so unforeseeable events can be the death of a spouse. Could be divorce or separation. Those things might allow you. So if you buy a house and then your spouse pops on you that they want to get divorced, and you sell it a year after you guys move in it, you didn't meet the 24 months, but you have ownership. You guys, both on ownership, but then the use wasn't. You'd get a partial exclusion if that was the cause for the move. If you have twins or more, twins, triplets, quadruplets, quintuplets, like if you just keep going. If you had more than one child unexpectedly, then that's going to give you grounds also for a partial exclusion. And then if you lost a job or something like that, that could also give you a partial exclusion. Other facts and circumstances, they would look at, basically this is where you throw the kitchen sink at them, saying, hey, we didn't anticipate something occurring, and this is the reason that we had to move. And you try your best on that one to get a partial exclusion. I've never seen too many of those come along, but they do happen. Now here's another little thing. There's a few points of clarity if you've been using your house at all as a personal residence after you've been renting it, or if you rented it after you use it as a personal, after the personal use, because they're treated very differently. So first off, we'll go to the first thing we were talking about, which is the disqualified use. If you'd used it as a rental, and you had a rental property and then you moved into it, the period of the rental is disqualified use, as we talked about. However, if you use it as your personal residence, your primary personal residence for 2 years, and then rent it after that and then sell it, as long as that sale is within 3 years so that you still meet the 2 out of 5, that portion doesn't count. We don't count that. Put another way, if I've lived in a house for 20 years and then I decide I'm going to rent it out, and I rent it out for less than 3 years, the way the rule's written is they don't count that as disqualified use so long as the date that you sell, 2 of those last 5 years, you used it as your primary residence. They don't count that portion as disqualified use. So in one case, somebody has it as a rental, they move into it, and they use it for their personal residence for 2 years, then they sell. There'd be a period of disqualified use that would mean that they'd lose a substantial portion of the exclusion. So let's just use round numbers. I rented it for 2 years, lived in it for 2 years, sold it, so I owned it for 4 years total. I would get half of the exclusion that I'm entitled to. So a married couple, married filing jointly, they'd have a $250,000 exclusion. A single person would have a $125,000 exclusion. You just cut the numbers in half. There's another portion of that, of course, which is the depreciation if they depreciated that property. That's not part of the gain. That's not part of the exclusion. That's depreciation recapture. It's actually at 25%. So you'd end up having to do that calculation. If, let's flip it around, I lived in it for 2 years, then rented it for 2 years and sold it, and I only owned it for 4 years, I get 100% of the exclusion because we don't count those years after I lived in it as my primary residence. So the reason that rule is there is to prevent landlords from just going in and moving into their houses for 2 years and selling, and every 2 years just selling one of their properties that may have substantial appreciation. They just want to, they don't want anybody to be gaming the system in that way. Now, where it's fully allowed, and the IRS actually has the calculation written out on its website, is when you have appreciation that's far in excess of what you're allowed to take. So for example, let's say you're in San Jose or San Francisco area where you've had this big huge run up and you bought a house for $500,000 10 years ago and now it's worth $2.5 million. So if you were to sell it, you'd have $2 million of gain, and you might be able to exclude $500,000 of it if you're married filing jointly, if you're following me. So you meet the use and ownership test, you get the full exclusion, but it's not enough. It's a $500,000 that's just going to put just a little dent. So you paid $500,000, you have $2 million in gain, so you're going to get be able to exclude $500,000 of that. You're still going to pay a big chunk of tax. If you want to avoid all the gain, here's how you do it, and they spell it out. You would take the house that you lived in as your personal residence and you'd convert it into a rental. And I would suggest that you rent it for at least a year. There's not a hard and fast rule on that. You just have to make it into a rental property, an investment property. Once it's an investment property, it can qualify under 1031 exchange. So you're allowed to go out and buy other investment properties with it. Now that doesn't mean you can go out and buy another house you're going to live in, but you could buy investment properties and after a while make those into your personal residence. Again, you work with a tax advisor on this, but you could exclude the $1.5 million in gain. So I could actually take a house, I've lived in it for let's say lived in it for 5 years, it's highly appreciated, have $1 million of gain, I'm only going to get to write off half of it, and I want to avoid the gain on the other half. I could convert that into a rental property, rent it to somebody, and what am I going to do in the meantime? You could either go rent a house, you can go buy another house, because you're allowed to use the 121 exclusion every 2 years, but you don't have to live in it the day that you sell it. It doesn't have to be your primary personal residence the day you sell it. You just have to have met the use and ownership requirements of 2 out of 5 years prior to sale. So then you would sell that, say a year later, and you would be able to 1031 exchange it into other properties. And then those other properties, after you buy them, technically you could actually go and move into those at some point and make them into your primary residence. Although you probably say, let's just keep them as rental properties. Let's go buy a bunch of rental properties and go buy another house that you could live in, or rent another house if you wanted to live in it, or just, you know, if you're in this situation, chances are you have the means to go out and buy another home and you wouldn't have to worry about it. But you can avoid the gain entirely if you want to. So it is a possibility. Last thing is how you actually calculate gain. And so as you've heard me say, depreciation is not included in the capital gains exclusion. So the way the IRS has you do the test is they say, what is your basis? You got to calculate up your basis, and I'll go over that in a second. You take the gain and you subtract the basis off the gain, that gives you a number. I mean, the total sale minus the basis is going to give you your gain, kind of the first level of gain. They say write down this number. Then you exclude from that gain any depreciation recapture that comes from having done your house as a home office or having taken depreciation if it was an investment property. So if you have any of those numbers, let's say you had $500,000 of gain, but you had $25,000 of depreciation recapture, you no longer have $500,000 of gain for purposes of this section. You have $475,000 of gain, and then you'd actually take that $25,000 of depreciation recapture and recognize it on your Schedule D. So there's a portion of it that would be excluded from tax, and then you'd have a 25% tax on that depreciation recapture. The way you calculate all these things, and the most important numbers are, what are you selling it for? It doesn't have to just be cash. It could be other properties that you're getting in exchange, other services. You figure out what's the actual sale price. 99.9% of the time, it's just going to be cash. It's going to be, you know, I'm selling it for U.S. currency, and it's easy to calculate. Make life world, you know, your world more difficult is to try to add Bitcoin. I don't even know any escrow companies that really want to deal with that right now. But you know, whatever you do, whatever you exchange, whatever the value is what your sale price is, and then from that you remove the basis. And basis is what you purchase the property for, plus we get to add things into it, and like that add it into it is your fees and closing costs. For example, abstract fees, utility services that you had to pay, recording fees, survey fees, transfer. You may have paid these when you bought the property, but they get added into your basis. You never got to write them off. Construction, you would add in the cost of labor and materials and any construction that you did. Even if you had to pay real estate taxes up through the date of the sale date, if you were paying it for something that you paid to the seller, for example, hey, I'm going to pay off some of the taxes, you didn't get to write that off because you didn't own it. So you would just add it into your basis. Bank or back interest, even recording fees if you agreed to pay some of the closing costs, and even if you paid some of the sales commissions, like, hey, I really want this house, and they shifted them over to you, that gets added into your basis. Don't forget to calculate that. Big things that are examples of improvements that we see some people miss, and I'm going to go through a whole bunch just to make sure that you're filling your head in with what things get added into basis, because this comes right off the gain. This is something you immediately write off, so it's like makes life easy. If we have zero net gain, then we don't have to worry about anything, right? Additions are anything that you added as a bedroom, bathroom, deck, garage, a porch, a patio, any of that stuff gets added into your basis. Your lawns and grounds, your landscaping, if you added a driveway, walkways, fences, retaining walls, swimming pool, any of that gets added into your basis. Systems like your heating systems, air conditioning, furnace, ductwork, central humidifier, air filtration, water filtration, wiring, security system, even if you put in a sprinkler system for your lawns, all that stuff goes in. Plumbing is your septic system, your water heater, soft water, if you live in, like I do in Las Vegas, everybody has a soft water system. All that gets added into your basis. Interior, if you have built-in appliances, those got added into your basis. Kitchen modernization, if you upgrade your the doors on all your cabinets, that type of thing. Flooring, wall-to-wall carpeting, all that stuff comes in. Fireplaces, even if you put in insulation into your attic or into your garage, some people are doing that now, underneath the floors, pipes, all that stuff, all of that gets added. Big things that you might do outside, satellite dish, new siding, even putting on a new roof, all that gets added into your basis. And so when you're calculating out what gain you have, you got to know what's the sale price minus what the basis is, and that's going to give you your primary number. If you never rented out your house, or if you never used a home office, or even if you did not take the deduction. In other words, you didn't do it on your Schedule C during the period of time when we had the dividend. They considered that a dividend, which isn't anymore. But if you did in the past 5 years or so, you may have some dividend recapture. And this does not include reimbursements that you took. Like if an employer reimbursed you for the use of your house, that doesn't get reported anywhere. That's not depreciation recapture. But if you did not have any of that, or if you did rent your house up, but you took zero depreciation, then you don't have to worry about it. You just use the capital gains exclusion that you have under 121. I hope that this helps, and I hope that you realize that anybody who says, oh, 121 exclusion, this is what it is. It's not. There are lots of little exceptions. We didn't even, like, there's some crazy ones that are out there that I don't want to bend your head on. But if you're a member of the service and things like that, we can actually have periods of deferment that are up to 15 years that we can stretch the test on. Even if you were deployed for 10 years, we can still go back and capture this. So the point of this is just to know that 121 is a boon. If you're selling a house, you don't want to pay capital gains. If you have too much appreciation, you can actually couple this with your 1031 exchange, you actually do the 121 exclusion plus the 1031 exchange. The way it works is the 121 exclusion gets added into basis. So if you have the $2.5 million house that you bought for $500,000, the new basis and the new properties is $1 million. You get to use the 121 exclusion, the $500,000, hit $1 million. You get to, if you're rolling it into other investment properties, you exclude the $1.5 million gain. It's an amazing, amazing tool. But there's a lot of different nuances to this that makes it something that you really should have somebody run the numbers with before you're doing it. But I hope that helps. Toby Mathis with Anderson Business Advisors.